Thank you. Un poche bene. Escribimos que en due. Figo. Ciao Duccio. Vediamo. Participants. Eccoci qua.
Ciao.
Ciao, mi senti?
Perfettamente.
Perfetto. E cosa vedi? Così facciamo un test.
Vedo la Digital Transformation after COVID-19 cosa e poi vedo Alessandro e Francesco, vedo voi due.
Ok, ma vedi il...
Ora mi sentite?
Eccoci.
Sì, adesso mi sento, sì. No, perfetto, vedo la schermata grossa con la presentazione e le piccole iconcine con il video.
Ok, fantastico, perché a volte la webinar precedente che avevo fatto non il PowerPoint, la slide, ma quella con le note di PowerPoint, quindi veniva un po'...
No, qua si vede bene.
Okay.
Scusa, e poi dopo io carico la mia presentazione, giusto? Faccio share screen e uso la mia?
Esatto.
Tocca a me.
Esatto.
E i partecipanti, quanta gente ci sarà? Sai più o meno?
Abbiamo 70 persone registrate.
Ok.
Poi ovviamente c'è un po' di friction da registrazione a attendees, quindi penso una quarantina. Mi aspetto, sì, una quarantina di persone me lo aspetto. Ok, si è collegato anche Paul, penso. Eccolo qua. I think Paul is setting up the audio.
Now you can hear me.
Yes, I can. Absolutely. Wonderful. So we're all here.
Great.
And for the first time, I'm actually trying to stream on Facebook live. So if this is okay with you guys, so because the webinar tool with Zoom has a lot of functionalities. So so far we're just the four of us, and everyone will just be exposed. And as soon as I click broadcast, then everyone will be admitted to the webinar. So
Perfect.
Something I will probably do in the next minute or so. Is there any question that you guys have? Any problem? Any something?
Well, I better turn my phone off.
Good job.
No question from me.
I'll do the same.
No question, everything is clear. So, by the way, great to know you, Paul.
Good to know you, Duccio. Here we are in the remote world.
Exactly.
Where are you exactly? You're in London or you?
We're just outside of London, near Maidenhead, out by Heathrow.
Okay.
Mm-hmm. How about yourself?
I'm in Milan.
Milan. Right. At least the weather should be nice now.
Yeah, the weather is perfect, and luckily enough, now we can get out of our homes, which is good because we are actually starting the phase 2, and so fingers crossed. Seems like the situation is improving because we had several very bad weeks actually. Yeah.
Yes.
But now it seems better. Good. I'm clicking broadcast now, so hopefully people should join. Okay. So the webinar now is broadcast, and I think you guys can see at least a part of the system. So okay, well, attendees. Okay. So I see people are connecting. So we have 5, 6 attendees now. So I think we'll give a few minutes for everyone to join us. And for people that don't know me, I'm Alessandro, the mastermind of this everything. And in the true Italian style, we'll give, let's say, 1 minute for everyone to join. It's a pity you guys are not here with me today, because in my other room, I have Peppa Pig at very high volume with my wife dancing with my little one. So that's that what happens when you're all remote and you have kids. I think Paul, one of our speakers today, has 3. So unless he has a 20-room mansion, he probably has the same problem.
3 little ones at online school with a dog barking in the background as well. So the whole thing.
So it's 5:31, so we're given 1 minute for the late joiners to join, but let's start. So I want to thank everybody to join us tonight. The topic is very relevant, and we'll go through a lot of numbers and cases and ideas. So first, I'm just gonna bore you for 3 minutes about the host today and our speakers. So why it doesn't work? Okay, there we go. The how-to. You should have these 3 buttons under your screen: chat, raise an hand, Q&A. The one that you have to click is Q&A. So you type your question, and we as host and panelists see the question, and we can answer the question. So since we have 2 speakers today, if you can just write who is the question for, it makes everything easier. And then something else, you can upvote questions. So the most interesting questions will be answered first. Then NOVA. I think everyone is a member of NOVA here, so I don't need to repeat what NOVA is. But something which I'm very proud is that it has been founded 20 years ago. So there is a lot of seniority in NOVA. There are 2,500 members between USA, Europe, and Asia. And I think there are NOVA members in every private equity firms of the world, almost. And not saying banking, consulting, technology. So that's, I mean, for being 20 years old, we have a lot of alumni around. What we do, we all know, clearly we support the participation of Italian MBA programs. We talk about meritocracy, management. We also have a blog where 2 young alumni of NOVA are writing a lot of interviews, which I suggest you to go on nova.com and see, nova-mba.com. And also we support mentorship. We have a strategic alliance with Mentors for You, which is the largest organization of mentoring of Europe, with like 3,000 mentors. So we're helping Mentor for You. And so if you want to be a mentor, just go on Mentor for You and become a mentor for undergrads. NOVA has a lot of very nice sponsors. And over the 20 years, we've hosted some great speakers. You see some pictures. Again, you can join the community. We have Facebook, LinkedIn, Twitter, Instagram, Slack, WhatsApp, pretty much everywhere. And this event is for the first time ever streamed on Facebook. I hope this works. So let's see. So today we're hearing from 2 speakers: Paul Quattrocasas, which is the CEO of Aqua Partners, which is an investment banking boutique, and then Duccio Vitali, which is the CEO of Alchemy, which is a digital transformation company in Italy. And then we have ideally half an hour Q&A, maybe more if there are more questions. I like to have these very interactive, so just ask questions and every question will be answered. Clearly, you will receive the recording as soon as possible. So in terms of our speakers today, Paul and Duccio. Paul has founded Aqua Partners 6 years ago. He's been a banker since his graduation from Columbia Business School. So he worked for Allegro Capital, ARC Associates, and advised a lot of players in technology with billions of deals. I think something which is very interesting is also an author of a book, Go Tech or Go Extinct, which I read and I suggest everyone to read because it's everything about digital transformation of large corporates. In terms of Duccio has founded and is CEO of Alchemy since 2012. Previously, he was a partner at Bain. We didn't work together when I was at Bain, but we kept in touch, and I told him, look, we're doing this. Maybe you want to join us and present Alchemy and what you guys do. 2 things that I'm very happy of having those speakers, that Paul has been very instrumental in drafting an idea that I want to pursue for the next 3, 4, 20 years of my life, Whereas I need to thank Duccio because Duccio purchased one of the company that I invested when I was in VC. It's called Seolab. Duccio was entering the Alchemy world, so I made 4x, and thank you Alchemy that purchased my company. And now I think one slide which will introduce the talk today. This I found it on LinkedIn. This is the e-commerce penetration in the US, 2009, 2019, and then coronavirus. In 8 weeks, we made the same penetration of 10 years. So this is what the COVID-19 is bringing us. This is the disruption of the market. So without further ado, I want to hear from Paul initially, and I know that he has a lot of cases, and he will share his screen, and we'll hear from him. Paul?
Great. Let's see if I can. I think you need to stop sharing there, Alessandro.
Okay, there you go.
Right. Well, that was a good lead in. That chart says it all, really, to me, and I'll get into that. I understand this is a very sophisticated crowd, so I'm going to go relatively quickly. I'm also told I've got 15 minutes. I typically would take probably 40 minutes for this, but I'm going to go through it quickly because I think most of you are up to speed. So we really talk about going tech or going extinct now in the context of how to reboot a company coming out of this pandemic. And you see things that you've just never seen before. I mean, this is just quite amazing that the Dow would have the best week ever, or since 1938, while millions of Americans are losing their jobs. I'll come back to this, but as of today, the NASDAQ is actually up year to date. It's actually up, where the FTSE 100 is down about 20%, and the Italian MIB index is down about 27%, which is interesting in and of itself. But crazy things we're seeing. One way or the other, we know that things are not going back to normal. That e-commerce chart just says it all. And if we learn today and we learn how to adapt today, we can have the opportunity to sail tomorrow. It's absolutely possible. And that's the thing I'd like to touch on today. Disruption has accelerated the need for automation across now almost every single industry, across companies' entire value chain, starting with supply chain and logistics. We've been seeing this automation for years, but it's really just accelerated. McKinsey pointed out in an article last month that digital strategy that was once mapped out in 1 to 3 year phases are now happening in a matter of days or weeks. And I've got a few examples here. We have Disney and Disney Plus. They projected it would take 4 years to get to 55 million subscribers. They did it in 6 months or within 6 months. And Tesco is another company that's adapted incredibly rapidly to online commerce. Now, because this point of resiliency being so important today, more than ever before, I want to look at the value of resiliency. And here I'm putting up a chart of 3 UK companies who are in the supermarket business. We have Tesco, Sainsbury's, and Ocado. Tesco's has something like 450,000 employees. I think Sainsbury's has nearly 200,000 employees, and Ocado only has about 15,000 employees. And yet Ocado is performing extremely well, even though it's nowhere nearly as profitable as these 2 companies. But what's especially interesting here, this is just over the last 2.5 years, is how they've performed since the pandemic, since the lockdown started. And this is a lesson, I think, for all companies in all industries. Ocado is essentially a technology company. It does deliver groceries in the UK, doesn't have any stores, but it delivers groceries through its automated warehouse and delivery vans, and many of you may be familiar with it. Whereas Tesco and Sainsbury's have probably 90% of their revenue tied up in physical stores. And they're only now still learning how to do online e-commerce, and the market is rewarding the company that has become most resilient, most automated, and frankly, most ready for the future. And Tim Steiner at Ocado will be the first to tell you that they have a plan ultimately to be able to run this company with almost no employees, apart from the employees that are designing the operations, designing the company, but otherwise everything else can be automated. And this is frankly where everything is going. If we look at where this puck is going to tech, we look at the market performance since I call it this is a mini crash. This is not the big one. So in this mini crash correction, we could say that we've had, from, say, mid-February highs to March 27th, which is where that the bottom, short-term bottom has ended, we see something very interesting. And that if you've been an investor in these US tech indices and some of the biggest US tech companies, you wouldn't have lost a lot of money. But more importantly, you wouldn't have had to go back much in time before you were losing money. So in the case of NASDAQ, this is when we hit the bottom, March 27th. If you had invested in May 2019, you'd still be up. But if you had invested in the FTSE 100 in May 19, you'd be down. In fact, you have to go back to before February 2012 to still be up. And we see a similar dynamic with the Stocks 600 Europe, DAX 30 and CAC 40, and also in the MIB in Italy. So there's a lesson here. There's a lesson here in terms of the power of tech. Now, if we just look at last year, 2019 returns, and this first quarter, last year tech was the best performing sector by far, was up 50%, 50%. Q1, interestingly, tech was the best performing apart from utilities. In other words, it lost the least amount of returns or funds. And what you could interpret from this is that the risk-reward rule is broken. This doesn't follow risk-reward. This should mean, well, this is higher reward. You're taking higher risk in tech. It should mean when you have a reverse of that equation, you're going to have a bigger loss. And that has not happened. The opposite has happened. So what does this mean for you and your company? Well, I'd like to start with what your investors think. So BCG has been surveying investors since this pandemic started. And in this survey from March 20th to 22nd, they talked to portfolio managers and senior analysts who are responsible for making the important buy, sell, and hold decisions. This is representing 4 trillion of AUM. And what did they say about the critical decisions and actions that corporate executives and boards have to consider today? Well, again, very interestingly, in addition to the near-term fire extinguisher to deal with a crisis, they're saying, we want boards and management teams to focus on the medium-term health. We want them to prioritize building key business capabilities to create advantage and drive future growth. And very interestingly, they're saying, even if it means lowering earnings per share guidance and delivering below consensus estimates. So they're almost saying, we want you to learn how to adapt to ride that bull where it's knocking you about so that you can sail and we can benefit from your sailing in 2 or 3 years' time. And this even extends to something that surprised me, which is that 60% of these investors are saying to the companies that still have a financially healthy balance sheet to take advantage of today's low valuations and actively pursue acquisitions to strengthen the business. So unlike many of the senior executives at our large corporate clients who are saying to us, well, you know, we're really battening down the hatches. We're cutting costs across the board, OPEX, CAPEX. We're cutting all travel and entertainment. We're cutting all consultancy budgets. You know, well, that may not be necessarily the thing to jump to. It's a natural reaction, but the investors are saying, hold on, this is an opportunity to take advantage and to grow. So what does it mean for you and your company? What it really means is you've got to skate to where the puck is going to be, not to where it has been. This is especially true for any established legacy corporate that's been in business for 100 years or 150 years. This is the time to reinvent yourself. Tech-based business models, they're taking over the world. If you go back 10 years, you'll see that 9 out of the 10 largest tech companies in the world, were non-tech. 3 of them were in oil and gas. Only 1 was tech, that was Microsoft. Now we have 7 of the 10 largest companies in the world are tech companies, and it's growing exponentially. In fact, 2 of the 3 non-tech companies, Visa and Berkshire Hathaway, are basically becoming tech. And we see this in the NASDAQ. So we often don't take the 30-year time frame, but if we do go back to 1990, including this dot-com boom and bust, the NASDAQ, which is tech heavy, is growing exponentially, has grown 1,900% in the last 30 years. The FTSE 100, again, you'll see the same thing with the CAC, the DAX 30, and the MIB, you know, is essentially flat. Now, this doesn't include dividends, so it may be up by another 100 or 200% with dividends, but still, it's not the future. It's not to where the puck is going. And if we look at smaller companies, the unicorns, they're also growing exponentially. In 2013, we only had about 20 unicorns. These are private companies valued at over $1 billion. Today, they're over 400. I mean, probably not 464 today. It's probably more like 400, given the prices. But the point here is that unlike perhaps in 2002, 2003, 2004, when many of us so-called tech experts, weren't sure if tech was coming back, we can now predict, forecast, assume with a very high level of certainty that tech is not going away. It's not going to be damaged by a market crash, a world depression, hyperinflation. It's here to stay because it's growing everywhere. There are over 100 companies being funded and founded every single day. Pre-COVID, it was $1 billion a day going into these new companies that are being founded. Now it's probably 400 to 500 million or a bit less. Just a question of what time frame we're talking about. But advanced technology is exponentially taking over the world. It's penetrating every single industry. Like that e-commerce chart that Alessandro showed, it's exponential. So name an industry sector and put tech after it, you'll find it. And you'll find thousands of companies, even in obscure categories like wine tech, where we found over 600 companies around the world. This is going to change even more disruption with 5G. So 5G is being built out now, of course, but by 2022, I would expect serious industrial impact across all industries. And this is mainly a good thing, but you have to know for yourself how it's going to affect you. But in terms of being able to use augmented reality, virtual reality, not just for self-driving electric vehicles, but for entertainment, to be able to project on a hologram a boxing match in your living room with haptic technology, that's not 10 years away. It is not. It is 2, 3, 4 years away. It is coming. And the way that you can think about it, I think, is how does it affect your customers, your consumers, and their behavior? And how's that behavior going to be reflected in their purchasing or using your product? The key to this is that it's not just another trend. We saw the studies done at the end of December 2019 that the last decade was the decade of tech compared to previous decades where it would have been the decade of commodities or oil and gas. I think we've seen the last of that. I think every decade from now until the end of time will be the decade of tech because we're racing towards the singularity. And the investment firm DWS essentially said that much when it said, this is back in April, the triumph of technology stocks is not cyclical anymore. This is going to extend for more than a decade. And we see certain companies that are smart enough, that have the vision and the ability to execute on it. So you might recall that we had this big thing called a financial crisis back in 08, 09 in the US. GM and Ford, you might recall, were bankrupt, and they had to be bailed out by the US government. And they were bailed out and they were reissued, IPO'd back to the public. And they were a effective pair trade. I mean, they tracked each other extremely closely until something happened. And that thing that happened was GM in March 2016 agreeing to pay upfront about $600 million for a zero revenue self-driving software company called Cruise Automation that had, I think, about 25 employees. Why did GM do that? Well, GM saw that its future over the next 10 years was going to be completely different. That in 10 years' time, we're not going to have vehicles that are driven by human beings on petrol, but we're going to have self-driving electric vehicles of all different shapes and sizes and forms. And they decided they couldn't do it in-house, so they had to acquire the very best software company with the right team that they could find. And that was in the form of Cruise. And what we saw here is over the following years, this is the pandemic correction, so it's hard to include that given the uncertainty. It formed a huge gap with Ford in terms of how GM treated the Cruise employees. It's almost a reverse takeover. It's a great story. So I don't know how much more time I have. I'll race to the rest, but Klaus Schwab said it all in his book, The Fourth Industrial Revolution, that decision makers, and I see this every single day, now more than ever, frankly, in the crisis, they're too absorbed by the things that are right in front of them. It's today or next week or it's next quarter or this year's budget, or it's the crisis. We've got to cut costs. Yes, we have to use the fire extinguisher when there's a fire, but we can't take our eye off the ball of the forces of disruption and innovation that shape our future. Sears took its eye off the ball. It was the #1 retailer up to 1990 in the US, #1, 53 billion in revenue, down to 16 billion in revenue, and it filed for bankruptcy in 2018. GE, we already forget about GE, but back in 2000, this was the shining star in the US. It was the leading industrial company, one of the leading companies in the world. And really, it should have been the world's first $1 trillion company. But a lot happened, and there's a lot of opinions about GE. Certainly they misallocated resource and they overpaid for certain acquisitions. But one thing they didn't do was focus enough on those forces of disruption and innovation shaping our future. And when they tried to, quote, become a software company, they tried to do it all in-house. And Jeff Immelt himself said, look, if we were to do anything other than do everything in-house when it comes to software and innovation, Thomas Edison, our founder, would rise from the grave and shoot me. And I think that's, frankly, the essence of what went wrong with GE. They didn't think outside of themselves and how to partner with where that puck was going. Thomas Cook, another one in the UK, this company was around for 178 years, 10 billion pounds in revenue, 20,000 employees. It wasn't like they didn't see it coming. I don't know if you know the story of Kodak, but this share price chart looks just like Kodak's. Kodak knew that the digital camera was coming because it owned the patents to it. But if you look at that 10-year share price chart, it's just like this. The board knew it was happening and they let it happen. They were asleep. Thomas Cook was asleep. They were more worried about refinancing their senior debt facility rather than realizing that their 500 stores were not needed anymore by consumers who could book their holiday on their mobile phone. If we look at the Dow Jones, I didn't talk about this earlier. I just think this is such an important point, that the Dow Jones companies tend to be larger companies than the companies, for example, in the FTSE 100. So you'd think if they're larger, they're elephants, and they shouldn't be as nimble, they shouldn't be growing faster, they shouldn't be creating more value. But what we see here is that in this same March 27th market correction, the FTSE 100 investors lost 8 years. 8 years, whereas the investors in the Dow Jones companies lost only 2.5 years. And the reason is, yes, there are tech companies like Apple and Microsoft in the Dow, but a lot of the non-tech companies like Home Depot and McDonald's and Caterpillar and Walmart are becoming tech companies. They get it, and they're executing by acquiring tech companies and investing in tech companies. You might say we can't become a tech company. We're not like Google. I'll just point out quickly, this is Amazon, what it looked like in 1996. It was nothing. It was a puny little $20 million revenue company that had no bricks, no mortar, no stores, no nothing. And look at it today. We all know Amazon today. It's $1 trillion company. And it's Amazon's mindset. And Jeff Bezos saying it's always day one that created this. And they're not finished. Jeff Bezos will be the first to tell you they're just getting started. So there is no limit to what you can do, no matter how small you may feel you are when it comes to technology, or how weak you may think your balance sheet is. Believe it or not, you can be creative and you can find a way to make it happen. I hear all the time we can't pay the valuations that are required for these tech companies that are raising all this capital. Well, I'll just say Andy Grove comes in here with his great comment, only the paranoid survive. And we have a couple of stories. I'm not going to spend much time on this. You probably know the stories of Naspers, but Naspers was one of those companies facing a crisis. It was on its knees. It was a traditional publisher, the #1 publisher in South Africa, a couple of billion in revenue. And when the dot-com peak ended, I mean, it just had some eyeballs on a few websites. That's why it went up here like every other company in media. But when that crash started, it was in trouble. It was frankly facing the end. It was going to go extinct. And Koos Becker, a visionary leader, said, we're not going to go extinct. We're going to find a way out of this. They decided it was China. They spent $100 million on a failed ISP in China. That wasn't enough. He said, okay, we failed. And that $100 million was precious. But he said, we're going to do it. And they took time to do all their homework and their research, and they decided to spend a precious $32 million for 46.5% of a small little company in China called Tencent, even while they were in a crash. And that's something we take for granted. It wasn't like everything's okay now, we can invest. It was, the world was crashing, and they still did it. And I think we know now what the story is. This has turned into a phenomenal success, where the $2 billion valuation of Naspers went to over $150 billion in value. And it became one of the world's leading digital media companies, including investing in many of the great companies we're up today. There's also the story, I won't go into great deal, Walmart, incredible story. 30 years ago, a big retailer in the US, all of the CapEx was on their stores. Nothing on IT or digital. Today, it's a completely different company. What happened was, back in early 2015, it wasn't just Amazon, it was Walmart feeling the threat from Amazon penetrating its market from books. Also, they had to change minimum wage and so on. So Walmart, as a very big company, had a massive decline here, whereas Amazon doubled its price. So Walmart knew it had to do something. It was already thinking this way. And they acquired Jet.com for $3 billion cash at a 13 times revenue multiple, which was shocking. I could go on and on about it. But basically, that acquisition brought in the talent and the mindset to Walmart that started to begin the transformation of Walmart that it is today. Walmart today, in fact, there was the quarterly announcement yesterday, phenomenal return, because Walmart smartly has grocery business that's allowed it to keep its retail operations open where its competitors have not. It's been an incredible success. And Mark Lohr, who's the CEO founder of Jet, has been the head of Walmart's e-commerce operation now for several years. And they just shut down Jet. He said, look, we've transcended that. And it's strengthening the Walmart brand now that matters. And Walmart is filing patents across this entire value chain in all of these interesting digital areas. And its mindset is, look, the same as Andy Grove. We could go away at any minute, the CEO, Doug McMillon, said last year. Now, I'll go quickly through this. If we acquire a tech company, the employees are going to leave. We know the story of Toys R Us, big company. It failed and went bankrupt. McDonald's, incredible story, where they are always thinking about the forces of disruption and innovation, not the thing that's right in front of them. They acquired a company last year called Dynamic Yield at a 17 times revenue multiple, not because of just the technology, the platform, or the revenue, or the customers. It was a great company that they'd been working with for a while before. It was the global chief information officer, Daniel Henry, said, it's more about the people, the data scientists that come with it, people that come with it, and their ability to move quickly with us. So they weren't worried that the people were going to leave them. Of course, that might happen. That's always a risk. But because they did incredible work with those people before they actually did the deal, those people are excited about changing the world with McDonald's. And they may leave, but the way this deal was done is they're unlikely to leave. They're unlikely to stay because they're still a team. And when people love working together as a team because they're winning and they're growing, they're not necessarily wanting to leave that, whether they're a part of McDonald's or not. So just to summarize here, I like this quote in one of McKinsey's articles last month. And I think this is so important. They said, just as digital platforms have disrupted value pools and value chains in the past, this pandemic, this crisis will create similar ecosystem level changes in motion, not just new changes in economics, but new ways of serving customers. That's what it all comes back to, is customers. And that's what's changing so rapidly. Look at the e-commerce chart. And across traditional industry boundaries, this is the big one. This is the, we could do a whole webinar just on that. We saw this quote from Mike Moritz a few weeks ago saying, we've all been turbocharged into the future by 5 years. I've just put up some companies here we're familiar with. You might have heard of, certainly Zoom, which we're using now. But companies like Beyond Meat, now worth $8 billion, it's worth half of Tyson Foods. Even though Beyond Meat has a couple $100 million in revenue, Tyson Foods has $40 billion in revenue. It's just incredible things that are happening at the moment. I'm not going to go through this. This is a slide we typically use for showing what the strengths are of corporates versus what the weaknesses are of tech startups and how they complement each other, and vice versa. And when you put all that together, the great technology, the great talent, you put together a corporate's clients, its channel, its brands, you get power. You get power. And you're not going to go extinct if you're powerful. And the time is now. We know that prices are coming down. You may have seen last week, it was reported that Monzo's latest funding round was done at a 40% discount to the previous round. Okay, I personally believe things are just starting, and we're going to see increasing pressure over the next 6 to 12 months. This is a phenomenal time for corporates to be in there looking at what we call the crash list. And there are plenty of opportunities out there. This is just some example companies for a food retailer or grocer. You can do this in every industry, and there would be 10 to 20,000 companies that are interesting to consider. Look, you're not going to acquire them. Think about a strategic investment that will be exclusive, or an exclusive JV. So it's all about, if you're going to go tech, you got to know what you're doing. We have a 12-step methodology we call Techquisition. It's all about being very, very, very careful and methodical so that you're reducing risk all along the way while you're increasing your value, so that by the time you actually get to completing your deal, there's almost no risk to that deal apart from the risk that you can't control, or the risk that is literally unpredictable, and that's where you want to be. You also have a pretty high probability of knowing how that deal is going to pay off. And this is today, certainly, we believe, the fastest, the best way to turbocharge your rebooting. So that's it. That's what we do. We help established companies transform themselves. If you want to talk to me after Duccio, anytime, there are my contact details, which you can also get from Alessandro. And I think we're going to do some Q&A as well after Duccio presents.
That's great. Thank you much, Paul. That was amazing numbers about what's happening in the world. And I very look forward to hearing from Duccio, because unfortunately, Italy is generally behind on digital, but luckily there is Alchemy, which is trying to do this in Italy. So Duccio, come on stage and show us what's the Italian situation.
Okay. Can you see my presentation now?
Yes, I can.
Okay, good. So let me project it. Okay, so now I'm going to talk about a couple of things. So the first one is how to create value with digital for companies. It seems like it is a very basic question, but actually it is really a key question, because we will see that most companies are actually doing a lot of things on digital, but they are not actually creating value with digital. So we will talk about this, which is, by the way, the very reason why Alchemy was founded 8 years ago. And the second point is we will try to understand what actually digital transformation really is. Okay, few slides. So I'm gonna take 10 minutes so that we have time for the questions later on. So I'll start with this slide, which is a slide that is though in different forms was also shown by Paul. So this is the market, the overall market cap of the top 5 companies in the world, December 2005 and December 2017. What happened? So if we go back to 2005, actually the top 5 companies actually saw just one company which was digital to some extent. It was Microsoft. Then in between 2005 and 2009, actually 2 things happened. So the first one is the Lehman crisis that actually decreased the overall value of economy, and then the launch of iPhone that to some extent was considered the foundation of digital. So what happened from that time on is that the economy actually grew a lot, almost tripled. And by the way, this is very, very much representative of the whole economy. And so to some extent, we can say that other things being equal, but digital actually created value in the economy. But what happened? So here you can see the evolution still of the top 5 companies by market cap, is that in 2017, the top 5 companies were all digital. So what this chart is saying actually that the value created by digital, and digital created a lot of value over time, was actually captured by digital companies. So now let's go to the following one. Okay, let's start from the upper side of the slide. So regarding to digital, there are actually 3 different phases for companies. So the first one is where companies are actually doing nothing with digital or doing poorly with digital, meaning that maybe they are not experiencing the e-commerce, they have, I don't know, their touch points are very poor. So this is the first phase. Then there is a second one where actually companies are doing good things on digital. So actually they have maybe started to work on e-commerce, they have, I don't know, good touch points, they have opened up channels, but they are actually doing business exactly as they used to do before. So they have actually not used these levers. And with digital, I'm talking about broader sense, all the technologies that also Paul was mentioning. So we're talking about data, we're talking about artificial intelligence, and so on and so forth. So actually, they are doing digital, they are using digital, they are open up digital channels, but the company is the same. And then there is a third phase, a first stage, where actually companies are using all these levers in order to really transform the way they do business. So means that increasing the value of the experience that they are providing to their customers, they are doing different things or the same things differently. And this is the distribution of companies. So few companies now, by the way, when we started in 2012, especially in Italy, there were a lot of companies still in the first phase of these 3 phases, let's say, evolution. Now there are few companies, but most of the companies are actually in the central phase. If we go to the lower part of the slides, you can see the value creation. And you can see that the very moment when companies are actually creating value for them with digital is in the first stage. By the way, in the second one, the situation is that they are even investing because, for instance, if you have, I don't know, social channels, you have to pay Facebook in order to have promoted your post. If you want to start selling products online at the beginning and you're not using well the channels, maybe you are cannibalizing your products and so on and so forth. The moment where you are really creating value is when you are using all these levers in order to really enhance the value that you provide to your customers. Then last year we did a study together with Egon Zehnder and Repubblica, which is one of the main let's say newspapers in Italy, and on all the stock the listed companies in Italy, so something like 350, and this is the real distribution of companies, so not that different from the one that we qualitatively we were actually drawing. So 1/3 of the companies in Italy are actually in the first phase. So we will see, it depends a lot on industries, of course. Then most of the companies, so more than half of the companies are actually in this segregated digital, and only 10% are in full digital. And by the way, considering Italy, we could also say that they are at the beginning of this first stage, which means that at the moment, the companies are investing, quote unquote, in digital, but they are not creating value. This is the same picture, but by industries. Again, still based on the same study that we did last year. And so you have that the industrial world is far behind. So and then of course you have exception, but this is the average of the industries. And then on the other side, you have financial services. And by the way, you can perceive that, let's say, the closer you are to final customers, let's say, the harder is the push in order to move to digital. But this is the situation. So why companies are struggling so much actually to do the first step? Because actually to transform the business is actually a very deep process, a process that can last 7 to 10 years. Why that? Because actually, I don't like this digital disruption word, but actually digital has introduced 3 great disruption in any business model. And these are the 3 main ones. So the first one is the customer experience. So digital has allowed company to manage directly the customer experience of clients from the moment when they start creating the need up until the very end. So when they start getting information to satisfy their need, and once they have the information, they make evaluation, then they make the purchase, they use, they repurchase, and so on and so forth. So think of a consumer goods company, automotive company. Actually, they were not exposed to clients. Of course, they were making commercials, they were making research, but they were not in touch with customers. Now, as a company, you can, starting from the moment when customer is not actually a customer, it's just a prospect, and start creating a need up until the whole value chain. Second, so digital has created tons of data. So this data can really enhance the way that companies manage their business. So years ago, companies were taking the decision based on historical data. Then in the 80s, the companies they started actually to make in-market research, try and anticipate. So now companies have the possibility to take decisions, all decisions based on, let's say, pricing, based on channels, whatever, based on actual real-time data. Of course, in order to do that, you need, first of all, to have the touch points. Second, you need to collect this data and to analyze this data. But then there is the fourth stage, which is the toughest one. You have to rewire all your processes in order to capitalize on this value. And then there is the third one, which is to some extent more subtle, because it's innovation. So 20 years ago, companies had to innovate on their core business. So they had the competencies to do innovation. The only thing is that they needed to have money, and the bigger they were, the more money they had in order to create innovation, investing in their R&D. Now the situation is much more complicated, because in order to be innovative, you need to be innovative even and also in competencies that you don't have. companies that are outside your scope. So it's no longer, let's say, sufficient to be big. So if you are big, not necessarily you can be innovative. And by the way, some of the charts that Paul showed are actually proving that, which is an advantage for small, aggressive, and visionary companies, but it's a potentially a disadvantage for, let's say, the incumbent. So it's very important for companies to try and develop models in order to internalize innovation, which is coming very often from outside companies. So again, these three levels are very, very complicated. So you can see that it's much more than having a nice and well-designed website or selling some products through Amazon or through your, let's say, proprietary e-commerce. And by the way, and this is my last slide, so to leave time and rooms for the question. So this is digital transformation. Digital transformation means moving from the second to the third stage. Digital transformation means using all the possibility offered by the new technology, digital data, machine learning, blockchain, and so on and so forth, in order to really rewire your business model to become more competitive. And it's a process that lasts 5 to 10 years, so it's a very long process, and it requires the whole company to move, not just a digital department. And it's really, let's say, critical to have a full commitment of the top management and the whole board in order to do and to carry out this process. Okay, so that was my last slide, so we can leave room for questions.
Okay. Wonderful. So let me put this as a cover for the questions. And while we'll wait for questions to flow in, clearly I got prepared. And I have, let me start with one question for Paul and then one question for Duccio. So for Paul, is that you call for an increased amount of M&A and inorganic strategies, but those are often unsuccessful. So what is a playbook for large corporate looking for inorganic growth? What should they do?
Well, that's a loaded question. What should they do? They first of all have to get their mindset right. So, and like this comes to Duccio's last point, which is you must have the full commitment of the management team and the board to achieve any kind of transformation, digital or not. You're not going to be, I don't think, very successful with inorganic activity deals, especially in technology, unless the senior management of the board get it and want it and are committed to it. And I think that all boils down to one thing. It's making a decision. I mean, really simple. I honestly believe, based on all, I mean, I've had discussions in the last 3 years, 2-3 years with over 400 companies, large corporates at C-suite level, one-on-one meetings. And, you know, after all of that, I say it really does come down to making that decision, because once the decision is made and there's excitement for it, then the organization will get behind it because it's kind of what people want to do. Now, there's an immunity layer in middle management. You know, very often you'll find the executive committee and other senior executives are wanting to do it, but as soon as the execution that's required hits middle management, this immunity system kicks in. And that is one of the reasons why we say inorganic works pretty well for those companies that are already on this journey. So if you look at, you know, the Duccio slide, if it's no digital, poor digital, I'd say that's not the right time. But if it's segregated digital, if they're already started the journey, they've got a CDO, head of innovation, they've got people working on it, then they can do it. But one of the beauties of an organic approach, whether it's a large strategic investment or an acquisition, is it can be the catalyst to waking people up in the organization. And very often, the right deal will cause the people in middle management who are not in favor of that deal to leave, and the people who are in favor of it to stay where they otherwise might have left. And I think that's one thing I haven't talked, and I've talked a little bit about, but talent has become more important than ever. We just saw a few days ago that one of the most senior executives of Disney is leaving to run TikTok. And we're going to see more of this, that these tech digital companies that are creating the value in the new economy are not only going to take companies' customers, but they're going to be taking capital, they already are, and they're going to be taking talent. And it's not only a question of how do we recruit top talent to help us with our digital journey, which is very hard for any established company to do on a standalone basis, but also what do we do to avoid losing our best talent to being lured away by tech companies? So that's my answer on inorganic. Is it can be, if you've got your act together and you're in that segregated digital space at least, then you can pull it off. You can make the decision. You can do inorganic. You do the right deal. You get the right people on board, like Walmart did with Jet.com, and you're on your way.
Very good. Well, Dude showed the slide with the numbers where you see that most of the Italian companies, the listed one, are still behind the curve. And the big question is, what is the extent of the Italian opportunity? Like what I see that, I mean, clearly the NOVA organization with its 2,500 members is looking for Italian opportunities. At the end, we're all Italians and we grew up in Italy, and sooner or later we want to come back. And we are young, well, I'm not, but most of the people are, and want to come back doing something digital in Italy. But what is there an opportunity in digital in Italy? Or the gap will become larger and larger?
It's a good question, because actually no, there is a huge opportunity, because this path toward digital transformation is a critical path for any company. By the way, this crisis has only reinforced the message to CEOs, but I mean, this is something that is kind of a critical way for everybody. What is needed? I mean, soon after the foundation of Alchemy was the October 2012. I was invited in an event in Capri, and a question similar to this one. So they told me, okay, what is needed for companies in order to capture the opportunity offered by digital? Actually, I talk about 3 C's. Which are, by the way, in Italian are SIM, C, and C, but in English no. But the first one, so these are the 3 C's which are needed in order to really be able to do this kind of transformation. So the first one is consapevolezza, which is awareness. So you need to be aware that this is critical, this is strategic. At that time, most of CEOs of traditional companies in Italy were not aware, so they thought that the digital was marginal. So now I don't think it's the case. Now everybody is aware. The second one is competencies. So that's the same. So you need to have competencies in the company. And again, at that time, there were few. Now companies are kind of, let's say, trying to hire more and more people coming from this world. The third one is still tricky. It's coraggio, it's courage, meaning that this is a long path. I think Disney invested $5 billion in digital transformation. I don't think there is a business plan which is showing the return. So you really need to believe that this is something that you have to get in, and you need to invest money and time and commitment. And here we are kind of still weak, I would say, in Italy, because most of the companies, they think that, okay, they are doing digital just because they are kind of opening up an e-commerce, investing some media, moving, let's say, some media budget from TV to digital, or kind of implementing a sales force. Is much more. So they need to have this courage. And this is what is missing potentially in most companies. And probably this crisis, this pandemic crisis, is kind of giving them more courage to face this challenge.
Wonderful. Then we have a question from Mattia. Mattia asks, some actors define the current situation as the valley of the coronavirus by comparing to the valley of despair. Do you agree with the definition? Because from today's presentation, you understood that this is more an opportunity / creative destruction accelerator. So that it feels that you guys are very positive, whereas everyone is talking about desperation. What's your take to both?
Yeah, I mean, I can start on that. And I'll be bold here and say that it boils down to leadership. You know, the answer to that question about, is this the valley of despair, depends entirely on the company leadership and the CEO and the CEO's behavior, comments, statements, actions, behavior, as reflected also by his or her colleagues. So it's whatever you want it to be. It's what it's going to happen whether you like it or not. If you happen to be an airline, if you're an automotive manufacturer, or you're involved in the automotive business, you know, if you're in a restaurant business, you do everything you possibly can to stay alive. But if you're doing it with the attitude or the mindset of, well, it's coronavirus, there's not much we can do, it's a black swan, which, by the way, we can argue separately whether it is or not, but nothing we can do. Let's just, you know, misery loves company, and let's just get through it and see how we do. That's despair. Okay, that's going to be a self-fulfilling prophecy, in my view. Companies that have that leadership with that kind of mindset will almost certainly fail. If the mindset is, okay, it's going to be tough, and we may not survive this, but we're going to fight like hell, and because that's what we do. Because we're going to fight for our customers. We're going to fight to actually learn from this and adapt our learnings into where the puck is going, which is digital and tech. And maybe we could do something that we never did before. Maybe we'll have some new ideas. Maybe we can, you know, all of us get on Zoom every day or every week and brainstorm, and we'll figure it out if we survive. We all know we may not make it. It's like going to battle. But if you do make it, then aren't we going to be delighted and excited when we come out of it? And that's not despair at all. I don't see any. I mean, there is despair wherever you are wanting to find it, and wherever you see it. So I mean, that's my answer. I think it all comes down to leadership.
Yeah, I fully agree with that. I think that threat and opportunity are actually the two faces of the same coin, and just a question of timing. And so the same effect was for Kodak, and in that case was a threat, and then for Nikon was an opportunity, for Blockbuster was a threat, and for Netflix was an opportunity. It really depending on leadership, as Paul was saying, and then it's a question of timing. So I think, especially in Italy, which are behind, so this crisis is really an opportunity if you are really, really fast in moving. Otherwise, if you're going to lose time, it can be a valley of despair for sure.
Wonderful. Another similar question, but more vertical, comes from Enrico, who is doing a startup in the data, and I think the startup makes a lot of sense. So he asks about the data, if data is becoming even more important in a post-COVID world, and again, if there is a mind shift in the boardrooms with positive or negative example on how much data is important.
That's a good question. I mean, I'll take a first stab at it. It's a really good question, actually. I think it's absolutely happening in the boardrooms of large tech and medium tech and unicorn tech and VC-backed tech. No doubt about it. To the extent that they're okay, that their balance sheet is okay, and their investors have said, look, we got your back. We'll do a convertible round, or we'll do a down round, you know, to slight discount if necessary to get you through this. But, you know, look, we've got your back. There are many other tech companies, perhaps, that are not as well funded that are going to really struggle. But for big tech and medium tech, growth tech, unicorn tech, absolutely. You know, as Mike Moritz said, everything's just been turbocharged 5 years, and it's all about data. If it's established non-tech, you know, based on the conversations that I've had so far in the last 4 or 5 weeks, I'm not seeing it yet. I'm not seeing it. In fact, all I'm really hearing is batten down the hatches. You know, and there's a certain expectation. It's conventional wisdom. There's almost an expectation that when this type of crisis happens, beyond the awful health effects and many of the tragedies we hear about with regard to families, beyond that, it's this. Well, it's a crisis, and we have to protect our balance sheet. We have to protect our P&L, and we can't put our company at risk. And that takes over the thinking and the decision-making at boardroom level. You know, even though the BCG survey is saying to the board, 60% of your investment base, your investor base, if you're quoted listed company with institutional investors, are saying, if you're healthy, we want you to focus on growth. We want you to focus on finding acquisitions that are a good fit and well priced. And of course, they're going to be talking about how to automate your operations and collect, first of all, get quality data and collect quality data and make use of it. But I honestly, I'm not convinced, at least in Europe, because most of the discussions we've been having in the last 4 or 5 weeks have been with European companies. I'm not seeing it all. I'm not seeing any of that yet, which is a bit of a concern.
Lucio?
Yeah, I can. Let's say out of the 3 main levels of disruption which I mentioned, so the customer experience, the data part, which is definitely a disruption, and the innovation, I think that the one where, let's say, in terms of mindset, companies, especially established companies, and especially, let's say, I would say in South Europe, are struggling is really data. So I would say that I'm talking about banks, I'm talking about telecom company in Italy. I mean, they have a huge amount of data and they are not using this data. And this is really a question of mindset. But this is the biggest opportunity, for instance, for smaller and younger companies able to exploit all the data, all the information in order to improve the customer experience whatsoever. But this is a challenge, especially in big boards of established Italian companies. Let's say, let's consider this one. We are also in Spain, which is very similar, the situation. Again, I would say UK, US is different, but in Italy, Spain, France as well, big established companies, they don't have this mindset yet.
Yeah, and I think just to add to that, I agree with that, Duccio, 100%. And we've been talking as well to a few Italian companies. I think it's fear that almost subconsciously enters the mind of decision makers. It's a fear. It's this, going back to this comment about, well, is it despair? We've got a fear, and fear puts one into a state of not panic, but flight or fight. Not a state of, a powerful state that is operating from a place of being creative and imaginative. And I'm not saying it's easy, of course. It's easy to be an armchair quarterback, but this is the true test of leadership, I think, and comes back to courage.
Good. A question for Duccio on my end. It's about the Italian structure, economic structure, where there are a lot of mid-sized companies, or even what they call small cap in the US, companies we make 100 million in revenues, maybe 300 million in revenues. What is the status of digital in those companies? So not being listed, so not being pushed by the market, not being at a few large that we have, but I'm talking about the real mid-market layer in companies.
And that's potentially a disadvantage of Italy versus the rest of Europe, because in Italy, let's say the biggest part of the economy is done by small, medium-sized company versus, for instance, UK, Germany, or France. And in those companies, potentially, from what I said, now is no longer a prerequisite to be big in order to be successful, because of what we said necessarily. And by the way, we're seeing, let's say, incredible companies in few months to become unicorn, whatever. So the point is more on mindset, leadership, talents, and this is lacking to some extent in most of the small, medium-sized company in Italy. This is also because of, in Italy, traditionally, the venture capital system has never worked, which is very different from the Silicon Valley, from the US. And in general, this VC ecosystem can be of great support to small company in order to scale up. And this is actually missing in Italy. By the way, Cassa Depositi e Prestiti a few months ago started a huge project. So they are putting 1.5 billion in GDP venture capital system, which is a new organization that aims at structuring the venture capital system in Italy. So we'll see whether it's going to be successful.
Very good, wonderful. Well, I'm raising a fund, so I definitely we'll definitely tap into this 1.5 billion. And another question for Paul, and then probably we are gonna close in the event. It's again about talent, and it's more cultural, because NOVA, I mean, it's started as an organization with the US MBAs. Now we also cover some top European companies, schools, but I mean, I remember myself going to New York, and it was a shock. It was totally a cultural shock. On I was told I could do things, I could grow, I should grow, I must grow. And then I came back to Italy, and it was a bit not the same. And the same for Europe. Like, you see the markets, and you see that unicorns, which you mentioned, most of the unicorns are in the US or in China, and just a few in Europe. So what can we, MBAs trained in the US with this mindset, do when we come back to Europe?
Well, you're doing it right now, right here. This is, you know, it's taking action and executing. I mean, I've been based out of London from 1991, so 29 years, having been born and bred in the US and gone to school there. But you know, I've been following this the whole time, this element of US tech and VC-backed tech versus Europe. And Europe has come a long way. Every country in Europe has come a long way in tech since 91 or since, you know, 95 when Netscape did its IPO. But it's come a long way in an absolute sense, not a relative sense. And I think that's what you're addressing, Alessandro, is relatively speaking, US has just gone from strength to strength, and so has China. And I think to answer that is it's a time, it's an opportunity to shine. So if you if you are a native European, Italian, and you've gone to get trained in the US, and that's huge, by the way. It's just to get inside the head of how that American tech or VC or financial system operates. That's a huge advantage, because I can tell you, most of the executives that I meet in the UK and Europe that haven't experienced that, you're not in the same wavelength, but you are now. So if you're again Europe native, you've been trained in the US or had schooling there, you've got the ability to be in the same wavelength, and you can bring back that knowledge, mindset, and take action, and never give up on sharing the belief and sharing what you believe in, and having energy in doing that. And look, you're going to get naysayers and people saying they don't like it, or they don't get it, or they want to go back to the old ways. Just like in a traditional company, you get the middle management that very often just pushes anything new out because it doesn't want risk, or doesn't want to have something new to deal with. But I think that's what it comes down to. And by the way, the example I give there are the Sandler brothers, who from Germany went to the US, they went to the West Coast, and they spent time in some startups that were VC backed, and they learned what the big digital plays were, at least B2C. This was going back in the early 2000s, early 2000s, I think it was, late 90s, early 2000s. They came back to Germany, London, and they ended up setting up the exact same business model that they saw in the West Coast or in the US in Germany. And it was very successful. 2 or 3 of these companies were very successful, and they ended up, as many of you probably know, setting up the Rocket Internet Fund, and then quoted Rocket Internet, and now they are perceived to be leaders in the European venture capital entrepreneurial scene. And if they did it, why can't you do it? Would be my answer. I mean, that was smart. So if, for any entrepreneurs in NOVA who have had that US taste, touch, feel, human experience, they're on the same wavelength, and they see anything that's working in the US that could work, for example, in Italy or in Spain or any other country, that's the opportunity, because human beings are human beings. If you deliver a solution that people love, it doesn't have to matter that much where you are geographically, as long as there are humans there that love it and they want it. That would be my suggestion.
That's great. Thank you. And I don't know if Duccio has something to end to talk again, or I will just leave it to Francesco, which is the president of the organization, for a closing note.
Oh, I'm fine. I think really, as you said, this crisis, I think, is really offering opportunities. It's just a question of perspective. So I think so the message is positive on my side, and then we'll see. So thank you very much.
Go, Francesco.
Yeah. So first of all, thank you very much, Alessandro, for moderating and organizing these and several of the other webinars. And also, thank you, of course, to Paul and Duccio for the time you spent with us. I will say this was some great content and great discussion. I'm going to be sending this recording to several people, and my phone was buzzing with messages of NOVA members that were telling me that they are really appreciating these. There's also some people who are following us on Facebook rather than through the Zoom call. I just wanted to mention a few things that we're doing on the NOVA side, since we spoke about digital, and maybe this can be a topic also for a future conversation. But essentially, besides boosting our digital presence in the recent months, thanks to Alessandro, but also a communication team, Gabriella, Alice, and the Mentors for You team, so organizing these webinars and communication. We're also continuing to organize events. This year, the NOVA conference, we host a conference every year with top speakers. We had Mario Draghi in the past. In 2006, we had Eric Schmidt when he was CEO of Google. We had Diego Piacentini, Massimiliano Magrini. We had several people from the tech world, but also from across almost any sector, essentially. This year is going to be hosted at Harvard and MIT, although there is the risk that due to COVID, we might have to do a digital event. We'll see how that goes. But we are in the process of organizing our first digital event. And we're also looking to launch a foundation to support essentially give back initiatives, because we have this great network of MBAs. Some of them came back to Italy or Europe. Some of them are around the world, and there's a chance to leverage this network for give back. Mentors for You was one of the associations that was founded by NOVA alumni, and it was mentioned at the beginning. And is one of the initiatives that we're going to support. But we also have our own digital transformation project ongoing right now. So what we're looking to do is try to build an integrated experience between the website, which is what we have right now, but also maybe an app, so that, for example, people can more easily upload their resumes and be searchable by recruiters. Because we have alumni that many of them are in different sectors, but many of them are, for example, former consultants. And then consultants, as Duccio and Alessandro know, they end up going into any sector, essentially. And many people from banking, consulting, or other industries want to get into tech, for example. And we had a few words with Magrini from United Ventures, for example, at the latest conference, who told us, well, if there was a way of posting job opportunities, when we invest in a startup and it needs to scale up, we might need to recruit a CEO, for example, with an MBA background. And I see that in several cases. But we're facing the issue of we don't have the expertise in-house to build it ourselves or to customize it ourselves. And we are a nonprofit. So it's not an easy challenge. And so it's taking us quite some time, but there are some talented MBA alumni, Luca Carnesale among them, who are looking into this. But let's say as a nonprofit, we need support and ideas. So if any suggestion come to mind from best practices that you've seen in other alumni associations, we're always happy to gather inputs, both through the webinars for our members, but also NOVA as an organization itself is run by volunteers and is fully non-profit. So any input or comment is welcome, both from you and from today's attendees. So thank you again, truly, for your time. This was very, very interesting. I have a deep passion for technology, so this was the highlight of my day, probably of the week, for sure.
Let me just say thank you to you, Francesco and Alessandro, for inviting me. Really enjoyed it. Very, very interesting. So thank you.
Very good. Thank you much, everybody. And as I said, we'll pause the recording as soon as possible. Bye-bye.
Thank you. Bye, all.
Bye.
Ciao, Ale.
Ciao, Fra. Grande. Sei rimasto solamente...
Ho pensato